Options trading for beginners. So this is sort of like an options trading for beginners course. This video is going to go into a lot of different specifics regarding options trading. And so depending on where you're at in your journey, you may just want to fast forward through some of this, find the chapter that you're most interested in, because I do hit a lot of different topics. I have designed this video in particular though for people who are beginners when it comes to options. I go into the real basics of it and the basics of trading and how things are priced. So if you're new, hopefully you're able to watch this all the way through and then have a really good understanding in one video how to begin and start in the options trading world. A little bit about me. My name is Paul Drapak. I've been in the financial services industry for nearly a decade, and I've used options in a lot of different ways, including generating income in client accounts, protecting client account portfolios, and I've even started and managed a small hedge fund that traded complex option strategies. And I love it that people are getting more interested in learning about their own investments and different ways they can enhance it or protect it or add extra income. So super excited about making this video for you. Let's start here. What is an option contract? Technically, it's a financial contract that allows you to either buy or sell something at a stated price sometime between now and a date in the future. There's three main parts to these financial contracts. First thing you need to know is the underlying security. This contract's designed to help you buy or to sell something. And what is that something? That is the underlying security. Most times it's going to be a stock. There's lots of different things that these financial contracts can be used on. Most people start out by using them on individual stocks. Now the second thing listed is going to be the price. On an options contract, it's considered the strike price that you can either buy or sell your underlying security for. And the last thing that they all contain is an expiration date. These contracts don't last forever. There's a time when they expire. Typically, when I try to explain what an options contract is, I use the analogy of a coupon. Both a coupon and an options contract have the same three things. Both will say the item. Both will have a price. I know that sometimes a coupon will tell you how much money off something is. But there are also coupons that tell you how much that you can pay for a specific item. And three, they both will have an expiration date. Rarely are you going to find a coupon that lasts forever. I really think that if there was some sort of market to buy and sell coupons, that it would be really similar to the options market. If you gain anything at all from this video along the way, super appreciate you helping me with the YouTube algorithm and hitting that like button. I'm really going to break down a coupon to the point where you might be a little bit annoyed by it, and I apologize in advance. But I really do think this will help some understand what an options contract is and how it works and why they fluctuate in price. Let's say that you have a coupon to buy a gallon of milk for $2. Because it's a coupon to buy something in the options market, that would be like a call contract. Because calls are the option to buy and puts are the option to sell. But I'm going to talk about that later. You have a coupon now that allows you to buy milk for $2. Let's say you can go to the store right now and buy milk for $1.90. If that's the case, your coupon's, well, it's worthless because nobody's going to use it because you can just go to the open market and buy milk for $1.90. However, if there's some sort of crazy shift in supply and demand of milk, and let's say that the milk is now $3 at the store, your coupon is looking pretty good right now. The intrinsic value of that coupon is going to be $1. Now, I know that we get coupons for free, typically as advertisements, but let's say that you could actually buy these coupons somewhere, if there was a coupon market. And maybe you bought some of these coupons for 1, 2, 3, 4, or 5 cents a piece because you knew that there was a possibility that the price of milk could really go up, but you weren't ready to buy milk at the time. So you pay 5 cents for this coupon, even though the market is $1.90, you paid 5 cents for a $2 coupon for milk. Now that milk has gone up to $3, you can use that coupon to go buy milk. Or you could sell it back to the market because people are willing to pay for it. It has intrinsic value of $1. So you've gone from paying 5 cents for the coupon and now it's worth $1. You own this coupon, it's a contract, you can decide to use it or you can decide to sell it to somebody else. Now let's relate that coupon analogy to what is an options contract. I'm using a program called Thinkorswim. It has something called On Demand, which allows me to go back in time. So right now I'm going back to December 1st, 2020. I'm going to look at the price of Apple contracts. So as you can see on this chart, it is approaching, it is December 1st. Apple right now is trading for $120.57. It's fluctuating. Like a coupon, these options all expire. If I go to shop around for my options contract, I start out by shopping for the expiration date. How long out do I want my options contract to last? Let's look at April, 136 days. I'm going to change the amount of contracts I see for the different prices. I'm going to say I want to see at least 10 on each side. These are the contracts that give us the option to buy. Put contracts over here are the options to be able to sell this stock at these prices. So we're looking at the expiration date of the 16th of April of 2021. It's 136 days away from December 1st. And then here is the strike prices. We can decide that we want to be able to buy Apple stock, let's say at $125. They say, all right, sometime between now and April, I'd like to be able to buy Apple stock for $125. The market is selling these options contracts between $8.70 to $8.80 per share for that right. And those are the three things within an options contract. The underlying security, in this case it's going to be Apple. Price that we able to either buy or sell at $125 is going to cost us either $8.70 to $8.80 per share to buy this contract for Apple stock, and we know that it expires in 136 days. Whoever owns this contract has the ability to exercise it at any time. And basically what exercising an options contract means is that they actually buy or sell the underlying security that's within the option before it expires. They say, yep, I want to buy Apple stock for $125 right now. That would be exercising it. I really hope so far that that's made some sense to you. Would love to hear from you, whether anybody's explained it like that to you before, maybe that's helped you understand it a little bit better, or if you're still not really grasping what an options contract is, I'd love to hear from you too. So just please let me know. I want to make follow-up videos to this one. So if I'm not being clear or if something's not really making sense, please let me know and I will try to fix it. As I've sort of skimmed over earlier, there are option contracts to buy the security and there are also option contracts to sell the security. Call options are the option to buy. I used the call option in the example earlier. We were looking at Apple and we're looking at the price it would cost to be able to buy Apple in the future. And that is a call option. If you own a call option, the higher the price goes of the stock that you own the option for, the higher the price of the options contract. If you own a call contract on a stock, if the stock is increasing in value, the call option will also increase in value. A put option is the opposite. It is the option to sell the security at the strike price. So if you own a put option and the stock is decreasing in value, then your option will be increasing in value. It may or not be helpful to understand that when a call option is actually to call a stock away from somebody else, you have the ability to buy it, to call it. And if you have a put option, that is the ability to sell to somebody else. So you are putting your stock on them. You are selling it to them at a stated price. So there actually is a grand total of 4 positions that you could possibly have with an options contract. Because you can not only buy an option, but you could also sell an option. So you could buy a call contract, or you could sell a call contract, or you could buy a put contract, or you could sell a put contract. And those are the only 4 different ways that you can trade options. Now this video is mainly for beginners, so I'm not going to get into multi-legged option spreads, but you can combine these options contracts and trade them at once to create what's called a spread strategy. Now there's lots of different ways you can do this, and it's really interesting to learn how the calls and the puts and the buying and selling of them together at different strike prices or different expiration dates, how they work together and how your risk changes when you put those together. But I'm pretty sure that's more of a advanced video. We'll avoid that in this video, but I am excited to make one about my favorite option spread strategies. Before we go any further, I think it's important to know that when you buy one options contract, it's actually controlling 100 of the underlying security. I know that's a little strange and it can be hard to wrap your mind around, but they don't have an options contract for let's say 1 share of Apple stock. Each options contract is for 100 of the underlying security. I do feel like that's a little outdated, and eventually that may change. I've seen things in the options market change over the years, like the amount of expiration dates, for example. But as for now, if you're buying an options contract, it's going to be for 100 stocks. So when you're looking at the price of options, you technically have to multiply it by 100 to know how much it's actually going to cost you to purchase it. Let's look at this for a minute in the Thinkorswim platform. I want to show you what those 4 positions look like when you buy a call, when you sell a call, when you buy a put, and when you sell a put. How much those cost, how much money can be made, or how much money can be lost based on what happens to the underlying security. All right, so we're going to stick with Apple. It's a stock everybody knows, something that we've mentioned before. And I'm going to use the same on-demand screen that I had recorded earlier. So right now, the price of Apple currently, as it's constantly moving, is $122.13. And so on the April contracts at $125, it is now $9.75 to buy, or if you're looking to sell it, you can sell it at $9.65. Very similar to buying and selling stocks, there's a bid price and an ask price. This is the auction taking place. There are buyers and there are sellers. So we know that the sellers are trying to sell the $125 strike price on the call options. This is the call side of things. These are the put options. These are the put side of things. That they are selling them for $9.75 for the $125 strike price. Or there are people that are willing to buy it right now for $9.65. They're just not matching up exactly right now. That price difference between the bid price and the ask price is called the spread. As a general rule, you really don't want to trade options when the spread is too big. There tends to be less liquidity, and due to that, a lot of times it's really hard to get out of the contract later if you really need to. So I'm going to go ahead and buy this contract now in this virtual account. And they have a fake $100,000 here. This is December 1st at 10 a.m. in the morning. We're buying $125 call options in Apple that expire on April 16th, 2021. And as I confirm that, I have 10 contracts here. Let me just bring that down to 1 contract. I go to buy, I go to confirm and send. It's reminding me that this is going to cost me $985 because if you remember that even though this is $9.85, it's controlling 100 stock. So I have to pay that $9.85 for all 100 shares that I can buy with this contract. I click send. It tells me my trade price right here was $9.85. If I go to the Analyze tab and I put my position in here, this is letting me know what my profit and loss is based off of the price of Apple and how it changes. So we have to remember, we have a lot of time on this contract. A lot of people don't trade this far out, but this is several months. It's over 130 days before this contract expires. So there's a lot of time value in here, and there's also a good amount of volatility value in here, but there's no intrinsic value because if we were to exercise this option today, that would not make any sense at all because it would be worthless. It's a $125 coupon when you can go to the market right now and buy it for $122 or close to that. This line here shows me my profit, and you'll see my profits here change. Ooh, that's hard to see, that green. That green is actually on expiration date. You'll see when this option expires, if it expires at that price, and down here below is the price of the Apple stocks. And right now it's $122. You can see the price is always changing as stocks prices always do. And this red line right here is our break-even price for what we need to not be losing money on this position. Now it hasn't been very long, but the price of Apple has gone down since I bought it already in this play account. So it needs to go up to 123.47 for me to not lose money as of today. But let's say, so right now we are down, if we hover over here, you can see the $51.20. We have lost $51 as of right now. If the option expires at this price in April of 2021, you'll see on the green line how much money we'll have, and we will have lost the whole $985 because it's less than $125. And you'll see right here where the profit line starts. If it's $126, we don't lose all of our money, but we still lose quite a bit because we paid $9.85, and it's really only worth now from 125 to 126. It's really only worth $1. So we would lose $885 of our $985 that we put in. However, we can also see that if this goes up to $126 by the end of the day, we're actually profitable because there's still lots of time value left and there's lots of volatility value left in there, so that we would make $124 today if it went up to $126 per share. Now, there's a lot of room for it to grow. Let's say the stock goes up to $140 at expiration. If I hover over $140, I can see that my profit is going to be $518. And if it gets there by today, it'd be over $1,000. But that would be a really crazy day for the stock to go up that much. Now, what does it look like if we were to sell a call? Let's add a simulated trade of us selling a call by, let's say, the end of the month. So it's December 1st in this example. Let's say that we want to sell a call for $129. Now, let me remind you that selling an option is actually a little bit more advanced because you're giving up control of the contract. It's the one who buys the contract that has the ability to exercise it whenever they want. And when you sell it to somebody else, you're selling a contract, you're generating cash flow, you are making money. You are not buying a contract, you are selling it. So in the transaction, somebody is paying you for this right. Now, although technically you can sell options on stocks you don't own, it is highly recommended when you're new that if you're selling call options, that you own the actual stock that is in the options contract, because somebody has the right to buy that stock from you at the strike price. Let's look at selling a call contract on Apple for the end of the month here in December. Let's look at selling the $130 option contract. It expires December 31st, which is in 30 days. The strike price is $130, and right now it's going for around $2 per share. So if I click on the bid price, it pulls up an order to sell. I am going to just do one contract. Each contract is worth 100 stock. With this simulated trade, I'm going to lock in that price and pretend that we just traded it for $1.98. Let's look at our risk profile. Now this looks a lot different because we sold the contract. So we make money if anywhere between $132 all the way down on this contract. And that should make sense because we're getting paid to put this contract on. We have sold it for $198. So that is the most amount of money that we can make on this contract as sellers. So the person who bought this off of us, though, can call away our stock anytime that they want between now and December 31st for $130. Anything below $130, we keep that profit of $198. Anything above it, we start to lose some of that money that we had made. And what this is really showing here is that, let's say we go to $140. Let's say Apple goes to $140 by December 31st. This is saying that we would have lost about $800 in possible profits because we have to sell our stock to the person who bought the call for $130. So the difference between $130 and $140 is $10. That $10 times 100 contracts is $1,000 in lost possible profits. Except this is calculating in the $198 that we received for selling this contract earlier. Now let's take a look at buying a put contract. We go to simulated trade. We're going to go to the put side of things. And let's say that I want to be able to sell my Apple stock for $120 sometime between now and the end of the month. From December 1st to December 31st. I can say I want to buy the put for $3.25. I'm going to just buy one contract, even though my platform automatically assumes 10. I'm going to switch it down to 1. And let's say I do decide to put the trade on. I'm going to lock that price in, and that I have bought this contract for $3.20. Let's take a look at the risk profile of this trade. Now you can see as the stock goes down in price that my options contract gains in value. The further down the stock goes, the more money that my options contract is going to be worth. Now let's look again. If we were to do that same contract and we were to sell it instead of buying it. When somebody else buys a put contract from you, as in you sell them the put contract, they have the right to sell their stock to you at that price. Now they own the option because you sold it. They are the ones who are in control. They can put you their stock at any time. So what you are saying when you sell the put contract is that you are willing to buy, in this case, Apple stock at $120, that's the strike price, anytime between now and December 31st, somebody can put you their Apple shares for $120. Now right now it's trading at $122. I'm sure you'd be happy to buy Apple at $120 right now. But if the stock goes down, you have told them that you're willing to buy it at $120 anytime between now and in the future. So you're going to need enough money in your account to be able to buy this many shares of Apple at $120 before your custodian will allow you to sell these contracts. As a beginner, I really recommend that you stay away from selling contracts unless I would say it's a covered call, which is selling calls on stocks that you already own. This is more of just to get you familiar with how buying and selling options work. You can see here that if the stock goes up in price or down in price, the most profit you're going to make is $315, and that's because that's the money that you collected from selling puts. But you have a lot of risk on the table. You have a limited amount of profit to make and a lot of risk because if the stock goes way down for whatever reason, you are responsible for buying it at $120, regardless of what the open market price is. Let's get into the mechanics of how to trade options really on any platform. I know it's going to look a little different depending on what either app you're using or what brokerage firm you log into when you make trades. But they're so similar that I think that you'll be able to follow along no matter what platform you use. There's 3 things I want to go over in this section. 1 is the difference between a limit order and a market order. 2 is going to be the spread or the bid versus the ask price. And 3 is how to locate the option that you want to buy or sell. When you're dealing with options, I almost always am going to recommend that you do a limit order. Now the difference between a limit order and a market order is the same whether you're using options or stocks, but I'm assuming that you're a brand new beginner at this and you may not know the difference between market and limit. A market order is letting your broker know that you are willing to pay whatever that somebody else is willing to sell that option for. The advantage to this is that your order will get filled because there is somebody out there somewhere who's willing to sell you that option. Now, the huge downside of this is you don't know what price it's going to be. You can look on your platform and see about what the price is going to be, and likely, if it's a really liquid stock and there's a lot of trading volume, that it's going to be close. But when you put a market order on, you're giving up control of whatever you pay for that option. A limit order is when you put in the maximum price that you're willing to pay. The downside of this, though, is if the market never reaches that price, then you never buy the option. You just have an order sitting out there being unfilled. So you sort of swap control. You have control of price, but you don't have control whether it actually goes through or not because somebody has to be willing to sell it to you for that price. You should be able to look on your platform and see what people are willing to sell that option for right now and how much that other people are willing to buy that option for. And usually I'll put a limit order on somewhere in the middle of that spread, or I'll even put my limit order on for the price that people say they're willing to sell it for and hope that gets filled there. When you look at it on your platform, it's likely going to say the bid price and the ask price. The ask price is what sellers are asking to sell it for. They're putting their option up for sale, and this is the price that they're putting on it. That's what they're asking for it. And then there's a bid price. If there are other buyers out there that are willing to pay for this options contract, they're putting a bid in. And it's when the bid and the ask come together that a transaction takes place. There's constantly people bidding and asking all throughout the day, so the market's constantly changing, these numbers are constantly changing, and the difference between these two prices are called the spread. And as I've mentioned earlier, you really want the spread to be as close as possible. It just shows that there's more volume and interest in this set of options contracts, which makes it easier to get in and out in the event that you want to get out. And the last thing is how to find the options contract that you want. It's pretty much the same on all platforms anymore at this point. The first thing you have to choose is going to be the underlying security. You have to know the stock or the ETF or whatever it is that you want to buy or sell an option on. I'm going to use the Thinkorswim platform as I walk you through how to find these options contracts. First thing I'm going to do is I'm going to put in the ticker symbol of the stock that I want to buy a contract on. Let's look at John Deere. So after I put in the ticker symbol of the stock I want to buy an option on, then the next thing you need to pick is the expiration date. Each expiration date might actually have different strike price options. So that's why they make you choose the expiration date first. Let's look at March, which is 108 days away from December 1st. So I click on that. Right now I have 10 strike prices showing. I can put whatever I want. Let's say I want to look at 30 strike prices. Then it shows me 30 of them. And then the next thing you want to choose is going to be the strike price. And as you go down, let's say I want to look at the $350 strike price. Now this spread isn't a good example of being a spread that is huge. People are trying to buy it for 3 cents. People are trying to sell it for 78 cents. Likely you could put a limit order in there and get any price in the middle here, or it might not fill at all. But as you get closer to the money, there's more volume here, there's more action here, the spreads are a little bit more reasonable, at least on a percentage basis. This is only 70 cents apart here, which is less of a big deal when you're dealing with $9 and $10. So as I'm looking at these call contracts, you can see the bid price here at $270 is $13.65. As other people are out there right now at this moment that are willing to pay $13.65 for this contract. Nobody is selling them right now, because the sellers right now are at $14.35 or $14.40, as this is sort of changing. This is live as I'm recording. When these prices meet up, that a transaction takes place. Now, if I really wanted this option, I could put in a market order and I would guaranteed get filled. And likely it would be $14.35 that I pay. However, I take the control away from me and put it on the brokerage firm or the seller. I don't know what the price is going to really be, because somebody could snag up this $14.35 price right before I do, and then it could jump up to $15 or $16. I don't know who the next seller is. There may be lots of sellers at $14.35. But even then, I could have a lot of people that come in right around the same time I do and buy it. So that's the danger in using a market order. So when I put a limit order in, if I'm willing to pay the $14.35, I would much prefer to put in a limit order at $14.35 than just put a market order in, just as a general rule, because I'm telling the custodian, my broker, that I'm not willing to pay more than $14.35. So don't go changing the price as soon as I click on the button. So essentially those are the 3 steps to go in and find the price of an option. That's how I would instruct somebody to find out how to find an option premium. So price and premium really is the same thing when we're talking about options. So what actually happens when your option contract expires? It really all depends on whether your option is considered in the money or out of the money. When you have an option that's in the money, it basically means that if somebody were to exercise the option today, that it would have some value. So if we had our $120 call option on Apple that we used way back at the beginning, and the stock, let's say, was $122, it would be in the money $2. Because if we were to exercise it, Right now, we could buy it for 120. The option when exercised would have some value, $2. That would be the intrinsic value of that option. And because it has any value at all, it's considered in the money. Out of the money options is when if you were to exercise it right now, it would be worthless. Because if we had an option, let's say on Apple, for $125 and we were to exercise it, even though the stock is worth $122 right now, it would really be worthless because you could go to the market and buy it cheaper than what your contract allows you to buy it right now. So it's considered out of the money. When an option expires out of the money, essentially nothing happens. The contract just disappears. You'll see it in your account the day before, but then after the day of expiration, it's just gone. And you've lost whatever money that you've paid for that contract. If, however, you have an option that is in the money, if there is any value at all to this options contract upon expiration, it will exercise automatically. So if you have a call option, it will buy those shares of stock at the strike price on your behalf automatically. If you don't have enough money in your account, you're going to be getting a phone call from your brokerage firm asking you to add extra money into your account to help pay for that stock, or they'll sell that stock eventually for you after X amount of days of holding it without you paying that extra money. It's considered a margin call, but hopefully you have the money in your account to buy those shares. Otherwise, you should have sold the options contract before it expired. Depending on the brokerage firm, they start giving you strikes for that sort of thing, and after a few strikes, you're out of there and you can no longer trade. So just be aware of what's going on, please. And here are a few things that you should consider when you're trading options. Whether you're buying or selling options, you definitely want to be aware if the underlying security is going to pay a dividend sometime between now and the expiration date. That can change the dynamics of your options trade, especially if you're short calls, because then you're obligated to sell stock to somebody at that price. And if they exercise before the ex-dividend date and you don't actually own the stocks, then you're going to be short those shares. And if you're short stocks that go ex-dividend, then you are responsible out of your own pocket to pay what the dividend is. So don't sell call options on stocks that are going through a dividend process. Also, you should be aware of the open interest that a particular option has. You see, options are different than stocks because there's only so many shares of a stock available because the company issues those stocks. When it comes to options contracts, however, those are created sort of on the fly. When there's somebody willing to sell the contract and somebody willing to buy the contract, then the contract appears. And so there may be zero open interest, which means there's none in existence, or there may be thousands in existence already. And the reason why you should be aware of this is if the open interest is really low, then it's going to be hard to get out of this contract in the event that you wanted to get out early. And one of the last things to be aware of for sure is any sort of events that could make the stock price move significantly. Like there's an earnings announcement coming up, or if there's some sort of regular product announcements. I know that Apple is notorious for this, that when they're having a meeting or there's an announcement of some sort of new product coming out, the stock can jumble around, and if they come out with something big or unexpected, you could really make or lose a lot depending on your position in an options contract. I really hope that this was helpful to you, at least in a little bit. I'm kind of an options nerd, and I may have forgotten some things. So please let me know if there was something that you're like, yeah, man, you didn't even talk about this or that. Yeah, I've kind of made this video on the fly here, just trying to go off the top of my head of what I think that you might want to know about options. Hopefully this was a really good video for somebody who's just beginning, and hopefully that you've learned a little something about options by watching this. I would love to help you out more in the future as I continue to make videos that help you on your investment journey. Please subscribe. Would love it if you did, and we will see you in the next video.